Massar in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, we continue our coverage from Boston, highlighting the innovations and industries that drive this city. Today, we're at Reebok's headquarters. We'll hear how innovation is driving product design. Plus, we'll sit down with Steve Pagliuca, getting his thoughts on the trade war, market volatility, and the future of professional sports. And Facebook rolling out a new feature to protect user privacy, but will it be at the expense of its ad sales? We begin, though, with Reebok. We're here at the company's headquarters right here in Boston. Over a decade ago, Adidas bought the maker of the iconic pump sneaker for nearly $4 billion. Revenue dropped 3% in 2018, causing the company to cut costs even more. Now, Adidas is looking for Reebok to expand. One innovation helping to fuel that, liquid technology that's helping them make shoes faster and cheaper. Bloomberg's Ann Mostu shows us how.
The footwear industry is seeing a jumpstart in technology. Nike's HyperAdapt made self-lacing shoes a reality. Adidas's Futurecraft introduced 3D printing with comfort. And now Reebok's Liquid Factory is making intricate, lightweight designs along with the company's 100% recyclable footwear line, Cotton and Corn.
This is our 3D printing lab.
Bill McGinnis is head of Reebok Future.
Liquid Factory is a way to get away from using molds like every other shoe in the market does and draw the bottom of the shoe instead. So this is like 3D printing, only much, much faster.
It's an effort to streamline production and keep up with younger consumers.
The big goal is to go from, we're going to make 1 million pairs of one shoe in the exact same type and hope everybody likes it, and that was kind of the old model. And now we're moving to smaller and smaller batches, 10,000 instead of 100,000. And as you get tighter and tighter, you can get closer and closer to custom.
And how is that a benefit to Reebok? What are the benefits of new manufacturing?
So you can get a lot faster, so you can react much more quickly to consumers.
Reebok isn't alone. Parent company Adidas and rivals Nike and Under Armour have also moved into the 3D printed sneaker game. But Reebok's Liquid Factory material is proprietary. The process uses computer software and robotics to draw shoes in 3 dimensions.
We're actually faster than the old model right now. So each bottom unit takes a couple minutes to put together, and again, it's all automated.
Adidas bought Reebok in 2006 for $3.8 billion, and in 2010 began a turnaround to reposition it as a fitness brand by signing a partnership with CrossFit. Adidas says it's committed to the future of Reebok and moved its headquarters from the Boston suburbs to downtown this year.
The spirit of the company has changed dramatically. I mean, we were always a very established shoe brand. Moving down here, being in the excitement of this district, I think has the whole place feeling like a startup.
It does feel like a startup, breathing new life into its classic white leather sneaker. Ann Mostu, Bloomberg, Boston.
And for more on Reebok, let's bring in the company's Vice President of Performance Apparel, Barbara Ebersberger. It's so nice to have you here with us. And actually, I should say thank you for having us here. I want to talk about, because you are known for footwear, you're known for so much more in terms of the fitness industry, but I do have to ask you what's been so front and center for so many of us, for so many investors this week, and that is the U.S.-China trade negotiations. How do you folks as a company and who sell around the world see those headlines? What's important? Because I think we're trying to assess where manufacturing is happening for so many different companies.
Well, I think it is a very good question, Carol, and I understand that it's on top of mind for so many people. But actually, we are in the fortunate situation. We are part of the Adidas group, and we have a very diversified sourcing strategy.
And you've been doing that for a while, right?
Yes.
Diversifying your supply chain.
So this makes us less dependent on the portion that we are producing in China.
Okay, so not so much of an issue.
Not so much of an issue.
Having said that, China's an important market, right? Because you sell around the world.
Yeah.
And I am curious, as you innovate new products, and I said, you know, you're known for your sneakers. I remember your sneakers so well in college. But you guys have made a commitment to being about 100% fitness, and you've seen growth, dramatic growth in apparel. Talk to me a little bit about that.
Well, the fitness industry is not just about footwear, luckily for me. Apparel plays an important role, and specifically functional product and innovative product. So one of the examples is the Reebok Puma Bra, which we launched last year in August. And we, throughout our research, really talking to women, we realized that there is a real problem, despite the fact that there are a lot of bras out there, but they're either feeling pain while working out or not really feeling comfortable, so they don't work out at all. So we reached out and really created, with the Puma Bra, the first innovative bra that combines the second skin feeling with the support that you need while working out.
And I have to tell you, before we got started, you actually brought over a bottle of a very thick, clear solution, and that's really the chemical or the compound that makes up this bra.
Yeah, correct. That's a shear thickening fluid, or we call it SDF. It is when you press it softly, it is fluid and elastic, but when you approach it with force, it actually stiffens.
How much of what you're doing in terms of apparel, it's not just about design, although as I look at everything surrounding me, it is about that as well, but it is more about technology, different fabrics, really kind of exploring that to produce new products? I'm
in the industry now for 25 years, and I have to say over the last 10 years, there has been a gigantic leap in the innovations in apparel. And a lot of it is because of the manufacturing capabilities that we have today, but also of the innovations that we're seeing on the fabric side. And it's our job is to find out what the consumer really wants. So everything starts with the consumer, and then we need to bring it back and find new ways, address it by creating new fabrics, finding new suppliers, or in the case of the Puma Bra, really going outside the industry to come back to find a solution.
Does that mean you're working with a lot of either chemical companies or companies that are creating different types of materials? I think about when we all started working out, it was all just kind of the similar or same stretchy fabric, but I do wonder about what's the future of kind of fitness apparel.
It is going much more diversified. It is, yes, working with chemical companies, but it's also working really with the mills that create those fabrics in order to create the right components, the right ingredients that really solve the problem. And then I would say it is today much more than ever, and it will be even more in the future, about finding those smart fabrics that really allow you to personalize your garments to your activity, to your body.
Now, in terms of the apparel industry and apparel fitness industry, I mean, there's a lot of competitors out there. But from what I understand, you guys have grown that side of the business, I think, over the past 4 years by double digits. Do you continue to see that kind of growth?
Yes, luckily we continue to see that growth. Obviously, there is a lot of competition, but as we say, it's also a lot of opportunity still out there, because the fitness industry and the bigger wellness trend will be there to stay. And consumers are just not only looking for product that they can work out in, they're also looking for product that they can wear the other 10 hours of the day while they are maybe out with their children playing in the playground, or even commuting to work.
Right, we're living in those clothes. We started off talking about China, and I know you guys, I think, had your first fashion show in Shanghai, and you've also created, I think, a creation center in Shanghai last year. It's an important market to you. When you are either selling into China or selling into Europe or some other market, the U.S. market, are you designing specifically for that customer?
So we are looking very closely into the regional specific needs. And it may be as simple as creating product and then making sure that we have Asian or Japanese sizing available. But we are also looking specifically for big markets like China into what are the product needs specifically for this market. So that's why we opened our creation center there, and we're working very closely with the Shanghai center to make sure that we are not duplicating things, but also that we are maximizing innovations and product products that we are developing here.
One last question, because we were talking about it. Cardi B, to have as somebody you've partnered with, social influencers, social media, how important is that in terms of getting your message out and really kind of getting your brand out?
It's all part of our approach to storytelling, because we want to make sure that the consumer not just buys a great product, loves this product, but also has an emotional connection.
Right.
The same way that you have this emotional connection still with the freestyle.
Right.
And I have probably with millions of other products in the Reebok history. And this is important for us because this is what is the long-lasting impact that you can make with the consumer. And Cardi is helping us doing this.
All right, great stuff. Thank you so much.
You're welcome.
And thank you for having us.
It's a pleasure to be with you here.
We really appreciate it. That is Reebok's Barbara Ebersberger joining us here. Now, coming up next, we'll discuss how new legislation has impacted fantasy sports. We'll have the DraftKings CEO coming up. This is Bloomberg. Welcome back to Bloomberg Technology. In Boston, I'm Carol Massar. It's exactly 1 year ago that the U.S. Supreme Court overturned the Professional and Amateur Sports Protection Act, and that opened the way for legal sports betting. Now, 7 states have since joined Nevada to offer widespread sports betting, and daily fantasy sports company DraftKings is reaping the benefits. The company has seen over 17 million bets on its mobile platform to date for over $500 million in winnings. Joining us right now is DraftKings CEO and co-founder Jason Robins. So nice to be talking with you again.
Nice to be talking with you again as well.
Can you believe it's 1 year?
I can't believe it. It's been a lot that's happened. It feels like more than a year.
Well, a lot has happened. What has happened? What have you learned since the legalized?
It's been exciting. I mean, what we've learned is that there's a lot that's similar, but also a lot of differences from the fantasy sports product and how those customers respond. I was surprised at how many. Well, I was surprised at how many new customers came on. We thought it was going to be mostly overlap, and about half of our customers in New Jersey are brand new to the platform that we try, and we certainly advertise, so I'm sure they knew about the fantasy sports product before. But
is it a different demographic too, Jason?
They tend to be a little younger, but otherwise it's a similar demographic. It's actually quite similar. So it's just people with different interests in different products.
So talk to us about the stickiness. I'm always curious about kind of the retention rates, that you get somebody who's on your platform and they keep coming back.
It's actually really seasonal because it's driven by the sporting calendar.
Right.
So we always look at year-over-year metrics, which we don't have any for the sportsbook yet.
Right.
On our fantasy product, we retain almost 80% of our customers year to year. So really hard to tell, though. After the Super Bowl, there's a big drop-off. Then it picks up again for March Madness. So it's hard to tell what the true retention rates are.
Well, what did you see for some of those big events, the Super Bowl and for March Madness?
Super Bowl was by far our biggest day ever. It was huge. We had an unbelievable amount of participation. March Madness was actually a little bit spread out, so it's not the same as that one big day, but overall we had more activity at March Madness than we did on the Super Bowl. It's just over the course of several games instead of one.
So tell me a little bit about esports, and I'm curious, as you guys now a year in, where you're looking for new opportunities, what do you think is the potential for esports? Well,
esports is a product we've had in fantasy for several years now. It's got a very avid following, and we have some cool integrations, like you can actually watch the esports contests on DraftKings while you're playing. So I think it has a lot of potential. It's something that unfortunately in New Jersey is currently prohibited on the betting side, so we're not able to offer esports betting, but I'm hopeful that over time that will be possible because I think it would make a great betting product. I do wonder about kind of what's standing in the way of full nationwide adoption of legalized betting, online betting? I think it's just going to take time. It's a state-by-state legislative thing, and they all have a different process. Some have to go to the ballot, and after they pass the law. What's holding them back? Because I think everybody thought this would be additional revenues or something coming in. Well, I don't know that I would say that a lot of them are being held back. I think it's just, government's the slow process, and even after they pass laws, actually 4 states just in the last 2 weeks have passed laws, Tennessee, Iowa, Indiana, and Colorado. They're all a little different, but they all still have to go through a process of issuing regulations and issuing licenses. So, New Jersey was a bit of an outlier. You're seeing, for example, West Virginia and Pennsylvania that passed in Q2 of last year just starting to get operators live online in the next quarter or two. Right. So it's about a year later by the time they're finally getting live. It just takes a while. Yeah. How far away then are we from all 50 states being on board? I don't know if all 50. I mean, there's going to be some states that choose not to for a very long time. I think we'll get a very large percentage of the country within 4 to 5 years, as in 30-plus states.
I'm also curious about mobile because you guys did launch the first mobile app in New Jersey. I mean, what opportunities, additional opportunities do you see with mobile?
Well, mobile is where all of our volume almost is in New Jersey. I mean, we have a small amount of volume coming through retail, and it's a great space in Atlantic City at resorts, but it's just so convenient for people to use their mobile device. You can use it from anywhere in the state.
Right.
It's not just us. It's in Jersey overall. About 85% of revenue is coming from mobile now. So it's really critical, and it's also how most of the black market operates today.
Which is nice to know.
Yeah, well, it's where people want to go.
It's where people operate.
Yeah.
I am also curious about competition. We have Fox getting into this. I mean, how do you see that? Is it just the more the merrier, or do you see it as competition for your users?
We always knew this is going to be competitive, so...
But it's a big media name.
I actually think that's a great thing, and I'll tell you why. It mainstreams it in a way that we never could on our own, and I think it also is going to prompt other interesting partnership opportunities that emerge, because, as we know, once one big company in a space makes a move, others start moving faster, and I think a lot of the media companies have been kind of biding their time, figuring out their strategy. Now I think you're going to start to see some real partnership moving.
So you anticipate more big media names coming on and doing the same?
That's a guess. I don't have any reason to believe it, other than in every other market I've seen, when one big competitor jumps, the others tend to, at least some of them tend to start moving.
Jason, what does it mean for you guys? I mean, at one point you tried to get together with FanDuel, right? That got blocked by regulators. You have a deal, a partnership with Caesars, right? And they've taken an equity stake, and they're going to get a piece of some of your gambling revenue. So does that become, are you looking to do more with them, a bigger partnership at some point?
Well, we have a lot of really exciting things we can do with Caesars. They have an amazing set of resort properties, and I think there's a lot we can do over time with them as a partner. And we're also partnering with a number of other great casino operators. We're trying to partner with different media companies. Disney owns a stake in our company, so that's interesting to us. We think having multiple relationships is important, and Caesars is a really good one.
Do you think then, so then ultimately you can stay solo, go it alone, and just have these partnerships, or do you think ultimately you'll hook up with somebody else?
I don't know.
Especially as there's more competition.
I think whatever makes sense is what we'll do. Right now, I feel our best route is to stay solo, and that can change over time. Markets consolidate as time goes on, but right now I think we have an amazing opportunity in front of us. We're growing like crazy. We grew over 60% in Q1 year over year.
That's revenues?
Yeah, so we have a really big opportunity in front of us, and we'll have to see how things play out. And right now, I think our best bet is to stay alone, though.
All right. That's the first year of
First
Legalize.
year.
Jason, always good to check in with you.
Thank you for having me.
Really appreciate it. DraftKings CEO and co-founder Jason Robins joining us on this Tuesday. Coming up, Facebook is conceding users' demands for more privacy on the platform, but it could face backlash from advertisers. We'll have the details on that story. That's coming up next. And this is Bloomberg. I'm Carol Massar, and this is Bloomberg Technology live from Boston this week. Well, Facebook is close to rolling out a long-awaited privacy feature, but issued a warning to advertisers that improved privacy for users that will have at least one key trade-off: weaker targeting. Let's head to Bloomberg's Kurt Wagner in San Francisco for the latest on this. So tell us about this new privacy feature. It's called Clear History. Kurt, what's it about?
Yeah, this is something Facebook actually announced over a year ago at their F8 conference, and what it does is it allows users to basically take their browsing history from around the web and disconnect it from their Facebook profile. So right now, Facebook actually knows where most people travel, what websites they're looking at, and it uses that information to show them targeted ads. Well, the company says once this feature rolls out, you'll be able to disconnect those two data sets.
How easy is it for users to actually use this new feature to kind of protect their browsing data?
Well, that's going to be the question. Since it hasn't rolled out yet, we actually don't know what it's going to look like. Is it going to be really prominent? Are a lot of people, going to easily be able to go in and just click a box to disconnect this? Or is Facebook going to make it a lot more complicated? My guess is that it will probably be buried somewhere. I mean, there's so many features on Facebook right now. It'll probably be one of those things you have to hunt out and find. And as a result, I'm not sure how many people are going to actually use it. But again, we won't know that until it officially rolls out, theoretically sometime soon.
Kurt, you know, when I read this story, I thought, what does this do to kind of the mobile advertising or search advertising financial model? Could it potentially upend it and impact a lot of other companies as well?
Well, I guess you could imagine that if this does become a really popular feature and everyone suddenly says, whoa, you know, we don't want Facebook or others to be following us around the web and then showing us ads, maybe this could put pressure on other advertising businesses to kind of offer a similar service. Again, I would be pretty shocked. Most people, what we see is there is a lot of uproar around privacy stuff, and then a lot of people don't actually follow through and go and opt out of things. And so unless that really happens, I think this is more a small change for Facebook, but something that they definitely want to warn advertisers about.
Have we heard anything yet from the advertising industry about the impact or how they see this?
Well, because this was announced over a year ago, at this point it's just kind of like we're waiting and waiting for the finish line to get here. So there's not a whole lot being said right now, but I think at the time there was a lot of question marks, right? Like, if people use this, certainly could have an impact if you're a direct response advertiser and you want to be retargeting everyone who comes to your website on Facebook. This will impact you. But if people aren't using it, it really doesn't matter. And again, we won't know until it's rolled out.
All right, there's another story I want to ask you about, and this is, of course, about WhatsApp, and this is, the chat app that's owned, of course, by Facebook as well. A spyware hacking report. What do we know about it? What's the latest? I know there was a kind of flurry of stories today on it.
Yeah, so WhatsApp came out and said, hey, there was this hack, this third-party organization that kind of offers spyware technology for government clients, was able to get into WhatsApp. And the third-party company is saying, hey, we don't know who exactly was using the technology to do this, but WhatsApp has come out and admitted, yes, this did happen. They reported this, and they are encouraging people to go in and update their WhatsApp app to make sure that they have the latest software on their phone, which includes some kind of protection from this hack. But this is what came out late last night, and we don't know how many people it impacted, but it's definitely a concern.
Right, and the company involved is at NSO Software, which is a software company over in Israel. I mean, this isn't the first time that they have been on everybody's radar, right, in terms of concerns.
Yeah, I think that they do have a bit of a reputation for this kind of thing, and like I said, they oftentimes have government clients, and so anytime you have government using this technology to surveil people, and they said it's used more for crime fighting and things like that, but obviously you can imagine there is a fine line to walk there when you're looking at someone's messages for a potential criminal reason versus just looking to be looking.
Right.
And so what we have heard from Facebook is that they want this to be wrapped up soon.
All right, going to leave it there. Bloomberg's Kurt Wagner. We're going to take a break. Coming up, we're going to speak with co-chairman of Bain Capital, Steve Pagliuca. Welcome back to a special edition of Bloomberg Technology, live from Reebok's headquarters in Boston. I'm Carol Massar. Rising trade tensions between the U.S. and China have market watchers on edge. Federal Reserve Bank of New York President John Williams explaining the downside of raising tariffs earlier on Bloomberg TV.
I do think of the tariffs as, in a way, is like a negative supply shock. And so it has various effects in the economy. One is it affects inflation. It probably will boost inflation by a few tenths over the next year. It affects demand and growth a bit in the short run, but it also has negative effects on the kind of the value chains and how our economic system works.
Our next guest is no stranger to market volatility. He's the co-chairman of one of the world's leading private investment firms, Bain Capital. He's the co-owner also of the Boston's legendary NBA team, the Celtics. Steve Pagliuca joins us now. So nice to see you.
Great to be here, Carol.
So there's so much I want to talk to you about. But first of all, front and center, we've all been obsessed, if you will, by the U.S.-China trade talks, the back and forth, what seems to be maybe posturing, maybe not. How do you see it?
Well, this has been a long time coming. We've had a trade imbalance for 25 or 30 years. And I think initially, when you had emerging markets, it was a good thing, and it's lifted the whole global economy up. I think over 1 billion people have come out of poverty because of global trade. Businesses have prospered. But now is the time these markets are not emerging anymore, and so it's really a time to rebalance, so it's a more fair system, and I think that's what's happening right now.
Now, you guys at Bain, you have investments in China.
We do.
So I'm just curious, Kyle Bass was on our air earlier and just basically kind of saying China's not our friend. How do you see the Chinese market in terms of transparency issues and where they are positioning themselves against the rest of the world?
Well, we've had a lot of success in the Chinese markets, and we've invested. They just crossed over to become a service economy. For many, many years, it was driven by exports and manufacturing. Now it's a services economy.
Right.
So we haven't been that affected, and won't be that affected by the trade issues. So I think it's more of a global issue. And if you think about it, 500 billion of goods, comes in from China to the U.S., and 100 billion goes out. So that's a large imbalance. Obviously, there should be rebalancing, and I hope rebalancing and not retrenchment. If we get into a long-term trade war, it'll have negative consequences for each side.
What does rebalancing mean, though? How do we need to rebalance with China?
Well, we need to rebalance in terms of them taking more of our goods, having similar things on patents, protection of software.
Do you think we can
access
get that,
to markets
Steve, in terms of enforcement of that?
They've come a long way since the early days, and already they've said that the financial services companies can take control positions in China. And so I think they realize to be on the global stage, they're going to have to kind of have the same kind of rules as the Western economies, and we just have to negotiate something and come to the middle. I think it's too important for both economies not to get that done.
These are two individuals, President Xi and certainly President Trump, who like to win, right, and are thinking about their constituencies back home. Is that going to be problematic in terms of actually getting a deal done?
I think they're both deal makers and both strong leaders, and I think they're going to recognize that it is bad for each country to be in this situation. So I'm hoping that cooler minds will prevail. They are good leaders. They're trying to get something good done for each country, and they'll come to the middle. So
all the market volatility we see, do you just attribute that to U.S.-China trade negotiations, or is there something fundamentally also going on in our market economy right now?
Well, I think there's more than that going on. I mean, the good news is we're at record low unemployment, so that certainly puts the U.S. in a strong position. We're at really not much inflation as well. So I think it's a strong negotiating position. The markets are probably as high as they've been in a long time. We've had an 11-year expansion so far. So there probably will be some kind of correction or settling. But right now, the businesses we're in and the economies are doing pretty well. So
in terms of the companies that are under the Bain empire, if you will, anything in terms of the U.S.-China trade, has that impacted them to have to do anything differently in those companies in your portfolio?
All of the companies have looked at contingency plans in terms of changing the supply chain if it has to happen, if the cost of goods are going up too much. Not only our companies, but most of corporate America has gotten out ahead of this because this has been going on for a couple of years. So as soon as this started to go on, our companies worked with our folks to develop action plans. If this happens, how do you make it work economically?
So they haven't switched yet?
They're prepared to switch, and many of them are already diversified in terms of the supply chain. There have been many other countries besides China that have been involved in the global supply chain, and companies have the flexibility to shift those volumes. And companies are very quick and nimble in the United States, so they will get through this. I'd rather not have the trade war. I'd rather not have the tariffs.
Right.
I'd rather have it be settled. But I think the companies will be fine.
Steve, one other thing that certainly we've been captured by is the Uber IPO, right? And even the Lyft IPO. But I think there's been a lot of stories about what did maybe Morgan Stanley get wrong in terms of bringing this company to market. How do you see it? Did Morgan Stanley overvalue the company? How do you see that?
They actually came out.
Did you guys have any piece in Uber?
They actually came out at the low end of the range.
Okay.
So I don't know if I'd blame anything on Morgan Stanley. I think it was a well-done offering. But we had this volatility with trade. We have a market that is volatile in general because it's at an all-time high, and so anything to do with trade or political tensions, seems to affect the market in the short term. So if you remember when Google went public, Google took a beating and went way down, and now Google
Facebook
has
too,
Facebook
initially
as well. So there's going to be some volatility in these tech offerings, and I think they got hit at a very choppy time in the market.
I'm also curious about just kind of the general private equity environment, how you see it. There's a lot of cash. We talk about dry powder sitting on the sidelines. What do you think of valuations right now in terms of some of the PE deals that have happened?
Well, no question valuations are high.
Yeah.
But I believe I've got a question on too much money chasing too few deals in the 80s, the 90s, the 2000s,
You've heard this
2010.
movie before.
And by the way, I thought they were all true at all those times.
Yeah.
But Bain Capital has grown from about 36 million under management in '84 to 105 billion today, and had very successful returns. Our latest 3 funds are some of the highest returning funds that we've had. Why? It's because private equity really is a great business model. It really comes in and tries to transform businesses. And so far, the model has proven to go global, help mergers and acquisitions, companies get more efficient, companies get new products. The whole world has changed in terms of private equity, in terms of the value that's being added by Bain Capital, which was actually founded on the principle of taking consulting skills and bringing those to companies to create great businesses.
What are the kind of deals that you're looking at right now, or what are the kind of areas that you're looking at that you're finding interesting?
Well, we view it as a needle in a haystack business, and that's how to stay out of trouble.
Yeah.
You need to proceed with caution in these frothy markets. And so we have a global team of 1,000 people that are looking at thousands of deals, and we kind of cover the waterfront. But in the last 10 years, we've really become specialists in we've always had a big technology practice, so we've reorganized our company to have vertical markets, which include technology, healthcare, consumer retail, industrial, and financial services.
Right.
And we work together as a global team to look at all those opportunities. And you have to start with hundreds of opportunities, thousands of opportunities, and weed them down to a few per year.
What about the real estate that you created a real estate unit, right, I think, at the beginning of last year? And I'm just curious, I think you raised or wanted to raise about $1 billion. Did you hit that mark?
Absolutely.
Do you want to raise more?
We actually, it was a fantastic situation. Harvard wanted to get out of the direct business. They had a fantastic group that fit well with Bain Capital. They were only 3 miles away from us. And Dan Cummings and the entire team came over. One day they were at Harvard, the next day we had office space and they were at Bain Capital.
So it's worked well.
It was a seamless transition.
Wow.
They have focused on some great growth segments in real estate, such as medical offices, college dorm type facilities, biotech, which is booming in this area.
Ton here.
So they've been very successful, and we're very proud to have them be part of the Bain Capital family.
I got to ask you about sports a little bit. Otherwise,
Absolutely.
everybody's going to yell at me. I'm just curious. I'm sorry that you guys are done for the season. What did you learn this season, leading up to the playoffs?
Well, you always learn it's very hard to have that last playoff game and not be coming back because you think it's going to go forever. We had a great team. We have a great coach. And the ball didn't bounce our way this year. All the credit really goes to Milwaukee, who actually could win the entire NBA. Antetokounmpo is just an incredible player. But the future's bright for us. We'll have up to 4 first-round draft picks this year. Right. To add to a crew that is a very good young crew and a great coach and great general manager, Danny Ainge, with Grossbeck, our CEO, is fantastic. So the future's bright for our team. But this time the ball didn't bounce our way in Milwaukee.
It's just kind of the way it goes sometimes.
Absolutely. And I don't know if I watched the end of the Toronto-Philadelphia game, and a long shot from way out as time expired was going around. I had visions back to my high school days of that happening to me in high school, standing there watching that ball go in, and then your season is over. It's terrible.
Tell me about Mr. Irving. Is he going to be back with the team?
We can't talk about free agents or any kind of team movements right now, but I'd rather give the money to charity than give it to Adam Silver, who's a fantastic commissioner, but is very strict on these issues.
I'm also curious about sports betting. You've got Fox Stars. They've had an announcement. How do you think that's going to be changing the landscape?
Well, sports betting is already really out there in Europe. Right. It's kind of an everyday happening there. So we're way behind in that. I think it needs regulation. The leagues have to be on top of everything, the officiating, make sure the game is true. But it actually is going to create more fan interest.
And should the leagues have a piece of the action?
The leagues will mainly participate by getting more interest in the games, because it'll bring a whole group of people in. They're going to watch those games to see what happens and what baskets scored and what the scores are. So anything that causes more eyeballs on screens is great for the league and great for the players, and so it'll really add more excitement to the game.
Thank you so much. Really appreciate it.
It's great to be here.
Good luck next season.
Thank you.
All right, of course, Steve Pagliuca joining us here. Now, coming up next, after a quick break, Uber's struggle as a public company is raising some new questions. Are tech IPOs overhyped? We'll talk a little bit more about that. That's coming up. This is Bloomberg. Welcome back to Bloomberg Technology Live in Boston. I'm Carol Massar. Well, Uber turned positive in Tuesday's session, but the stock is still well below its IPO price of $42. And that's raising some questions about the company's valuation as well as the handling of its IPO. Well, someone who knows a lot about startups and valuations, Kent Bennett, he's partner at Bessemer Ventures. Bessemer, by the way, is no stranger to the tech IPO landscape. The company just saw one of its own investments hit the public market. We're talking about Pinterest, which is up 53% since its IPO. We call that a good IPO.
That feels good.
That's got to feel good. I want to talk to you about that, but I want to talk to you about a lot of things. Let's talk about, though, what happened with Uber. How do you see that? What happened? Did they price it wrong? I don't know. You understand this market.
Well, yeah, that's
and you understand valuations?
But, sort of. So we would say Uber is a pretty special company. So I Ubered over here. I think all of us have Uber sort of as a new verb in our lives.
I used it like 3 or 4 times
it's
today.
It's part of our lives. And this is a rare thing in the world, especially in the consumer world. So everybody has an opinion. Everybody has an opinion about the enormous value of that company. But it's also a really special company in terms of the amount of burn, right? Historic levels of burn.
Right.
And I think you could argue that they didn't do a good enough job telling all of us what they were doing with that spend. And so there are questions on, are they investing in short-term gains? Are they investing in long-term? We just didn't have a ton of information to know.
But Kent, you know with a company, it comes out of the gate. This is a company that's been around for 10 years. I mean, they've also got bankers who are advising them. Do you blame the bankers in this deal for maybe not helping tell the story accurately?
I don't know who to blame. I think this is a really hard one. Again, you have this historic company. Like if you step back, in 10 years, the company created, I guess today, $65 billion of enterprise value. So that's like unprecedented with a couple exceptions. So who knows what people are going to project in terms of the long-term value there. And, I think, again, you could argue that maybe they didn't arm public investors with enough information to be certain that the sort of multi-$100 billion potential outcome was there.
And as somebody who works with startups, invests in companies, and deals with IPOs, do you think that this is somehow impacting longer term or maybe even for the rest of the year, the IPO market? I mean, Beyond Meat had a fine IPO, different type of company.
Right. I think this is more of an Uber story, is my guess. I think there are a host of companies. We talk about Pinterest, PagerDuty in our portfolio, which we took public recently.
And it's done so well.
Done incredibly well, and they have incredibly predictable revenues and visible efficiency. So people understand how those businesses are creating value. And so I think there's a big pipeline of private companies that we look at where we understand how those businesses are working, and I think will be easier to sell to public market investors.
What about, though, when you've got a company that's been around for a decade but still not making money? That's problematic?
Well, apparently some people in the market thought so. I think, the question is, how are they investing that money, and is it rational? Are they getting a rational return? And again, if you read the Uber S1, it just wasn't 100% clear. My gut says absolutely that I'm going to Uber to the airport for the rest of my life. This business is going to be around forever.
Right.
And so, is that worth $300 billion of enterprise value in the long run, or 50? It's a little harder to say.
Speaking of investing money, tell me about how you guys are investing your money, where you're finding interesting opportunities. Consumer, you think about that a lot.
So I spend about half my life looking for the next Uber, IPO, belly flops aside. And that's a really, really hard thing to do. If you think about yourself as a consumer, how many things have actually come into your household in the past year or two? It's like a handful.
Right.
So we call these earthquakes. And so we spend our time looking for these earthquakes. The problem is you don't know where the next one's going to happen. They happen incredibly fast, and they're incredibly rare. So we listen in all the obvious places, and that means we listen in Silicon Valley, we listen in Boston, we listen in New York for these earthquakes, and then we have to be prepared to pounce whenever we see them. And I think a lot of what you've seen recently with incredibly fast rises in valuation of consumer-facing companies is because investors have figured out that these special phenomenon don't happen all the time, and when they do, they'll pay almost any price to get in.
Okay, having said that, though, where are you guys? I mean, Toast is an investment that you guys have done, and this is in the restaurant space, right? And certainly simplifying that process. How's that going? Where's it going?
Right, so we look for, in general, radical product market fit anywhere we can find it. Toast is a restaurant software company that entered this space with a bunch of legacy, you've seen the huge honking legacy restaurant terminals. Toast is a cloud-based terminal, so it's like a thin tablet that comes in, is constantly updated by the software engineers here in Boston, and it's just blown the competition away. So that was an easy one. When we saw the traction that company was getting in the market, we jumped in. I think we try to think a little bit systematically about from the consumer angle, every element of the consumer's life, including the businesses they interact with.
Right.
And so you go into restaurants, you go into dental offices, you go into hospitals, and you think about the technology that's now consumer-facing that might have an enterprise software model to support it.
Just got about 40 seconds left here. When we think about the consumer space, what is something that you think we're not really discussing right now, but maybe in 5 years it will just be ubiquitous?
Ubiquitous. I think hardware, which has gotten a bad name historically with investors because hardware margins have been thin, I think we're seeing incredible innovations in consumer hardware and robotics, and we could see many new purpose-built hardware devices enter our homes and have like ubiquitous adoption. So that's one that we're looking for. Has a particular Boston element. I just invested in a company called Bevy that has like the world's best water cooler. It's like Steve Jobs, designed a water cooler, and it's this incredible device that consumers rave about and are just, calling their employers begging for. So things like that, I think, may become more of our life.
That's pretty cool stuff. Ken, thank you so much.
Sure.
Really appreciate the time. Ken Bennett of Bessemer Venture Partners, excuse me. All right, coming up, everybody, we'll talk the future of mobility and competition from Uber with the president of Zipcar. This is Bloomberg. Before Uber, there was Zipcar, the car-sharing service launched in 2000 right here in Boston. I caught up with the company's president, Tracy Zen, and discussed operating in the city.
We're based out in an innovation district, which is where the tech hub is. So for us, that vibrant community of companies, but people, it's been a huge success for us. And on top of that, for us at Zipcar, the most important thing is people, it's our talent. So we're really lucky because we have access to great technology companies in Boston, but also access to top universities at our doorstep.
I mean, Boston has got to be kind of a great test lab in general, right? Because you do think a lot about urban planning and or the urban environment.
Sure, absolutely. It's one of those cities that's growing fast, but also like a good size where lots of testing. So what you see is a lot of mobility companies being based in Boston and doing tons of testing, and it's emerging. So it's really exciting.
I got to ask you about, the demographics of Zipcar today, because it kind of floored me when I went back and did some research that it's 20 years that this company has been around, right? I remember when it was introduced. So tell me a little bit about what is your typical Zipcar user today. Tell me a little bit about, your top and bottom line growth. Tell me about user retention. Give me an idea.
Sure. Well, our member base, everyone thinks we're a millennial brand because our brand is so fun and innovative, but we actually have members that range from 18 years old to 93.
Wow.
Right, but 40% of our member base are over 40, so we're actually, a bit skewed older. And we're really serving the people of the city. They're urban, they're smart, they're savvy, and they live and work in the city. That's our core base. And we don't really comment on financials just because we're part of the Avis Group, so I can't say too much, but our member top line growth is growing really rapidly, and I think as more and more people feel comfortable shedding their car and using services like Zipcar, it's been a huge momentum for us.
It's great that you bring that up because we were thinking about this talking in the newsroom that you guys are kind of a great test experiment or a great experiment of that whole idea of the sharing economy. There's been a lot of research about teenagers not so interested in getting, driver's permits or driver's license anymore, and it's not just in the US, but it's a global phenomenon. What are you guys seeing as kind of the experiment of that idea of the sharing economy and people maybe eventually saying, I don't need to own a car?
Well, what's fascinating is the company was founded 19 years ago, as you mentioned. At the time, there was no such thing as a sharing economy. There was no iPhone, right? This is how long ago it was. So at the time when the company was founded, the vision was really bold. It was this view that in the future, that consumers are going to want to pay for the trip and not the car. So that was how the sharing economy was born. And being pioneers in the car sharing space, we've been really fortunate because we've had 19 years to innovate and to experiment on how usage is changing. And I think as more and more services, as you mentioned, Netflix, Spotify, what have you.
Right.
I think the movement towards paying for access and less ownership is really going to continue to evolve.
Well, from what you guys are seeing over these 20 years, Tracy, and as you said, there's more options now that play into the sharing economy. When people say there's going to be a day when we're not going to own a car, do you see that actually happening based on the numbers and the data that you're seeing?
Absolutely. I think especially in cities, today over 70% of urbanites still own a car. And we've been chipping away at that for the last 19 years. And the numbers starting to fade away. I think as more people start to question, well, A, there's so much congestion. Do I really want to drive?
Right.
But two, the cost of ownership is just outweighs the hassle and so on and so forth. So I think services like ours is really going to help propel the reduction of personal car ownership over time.
So when somebody becomes a Zipcar member and part of your community, I don't know, what data do you guys see that they either give up their car or give up plans to buy a car. What do you know about that?
We see tons of people who are considering buying a car, and after they join, not only do they not obviously buy a car, but they also use a lot more other forms of public transportation, cycling and walking. So overall, they become much more green in how they behave and how they live in a city, so which has been huge for us.
So but you do see them giving up and saying, I'm not going to own a car.
Absolutely. We have so many members that tell us, would have bought a car, but I don't need to anymore because I use your service every single day. We actually have a commuter program that we just piloted that is really giving access for reverse commuters Monday through Friday. And they're like, well, I had to purchase a car to get to work, but now I don't need to.
What about retention? Because I always think about any of these services, you mentioned a Netflix, like all of these services, some of them spend a lot on marketing, right, and reaching out to consumers and then holding on to their existing user base. Give me an idea about that. Has that become a bigger part of your financial pie? You've got to spend more time and money on that effort?
Well, I think for any subscription business, retention has got to be a #1 metric for the business. I think for us, what we really focus on is great member experience. And I think it comes down to, A, am I getting a great service, but 2, is it a good value? So when we think about retention, we just anchor on how do we continuously improve our member experience. And as we do more and more of that, retention will naturally come.
Okay, I want to ask you about Uber and Lyft. Is that your chief competition? Who do you see as the competition?
So our competition has always been, as I mentioned, car ownership, right? If you think about that pie, it's huge, right? 70% of urbanites still own a car. And if we can chip away at that, that's a huge opportunity for us.
And that was Tracy Zen, president of Zipcar. And that'll do it for this edition of Bloomberg Technology. On Wednesday, we'll be live from the Boston Chamber of Commerce, speaking with Bijan Sibet with Spark Capital and also Sheila Marcello, Care.com CEO. This is Bloomberg.